Welcome to the research desk. Picture this scenario if you would.
Okay, go ahead.
So a 22-year-old quantitative finance graduate walks into their very first day of work at a Tier 1 investment bank.
Right, the cream of the crop.
Exactly. And this is someone who, they grew up in an era defined entirely by frictionless technology.
Oh, sure. iPads, instantaneous apps, everything.
Right, they carry a smartphone with an interface so intuitive that literally a toddler can navigate it. They leverage open source software. They use AI models that process plain English commands.
Yep.
So they sit down at their new desk, expecting the absolute pinnacle of modern financial technology, but instead they're confronted with this specialized, incredibly heavy keyboard.
The famous keyboard.
The one with the color-coded keys, and they're looking at a dual-monitor display running a black background with harsh, neon amber and green text.
It looks like something out of the Matrix.
It really does. I mean, it looks exactly like the control panel of a Cold War-era nuclear submarine. And the most shocking part? The bank pays a luxury car payment of $24,000 a year per user just to keep that specific software running.
Yeah, it's wild. And that, I think, is the central paradox we are dissecting today.
Yes.
Because despite that staggering price tag, and despite an interface that, frankly, aggressively defies every single modern principle of user experience design, this system sits on 355,000 desks across the globe.
Unbelievable market penetration.
It really is. It generates over $13 billion in annual revenue. It has survived 4.5 decades of relentless technological evolution.
And not just survived, right? It has successfully repelled direct assassination attempts from the most well-capitalized institutions on Earth.
Exactly. We are analyzing the Bloomberg terminal today. We have to figure out how this anomaly continues to exist and dominate.
Right.
So here's the core question. Is the Bloomberg terminal an unbreakable business flywheel built on, an optimized active habit?
Which is my stance, yes.
Right. Or is it a legacy relic? Is it protected entirely by institutional inertia, astronomical switching costs, and basically the deep-seated risk aversion of Wall Street executives, which is where I stand?
Well, look, I maintain that the market completely misunderstands Bloomberg. The fundamental error that technologists and analysts make is categorizing Bloomberg as a data company.
Interesting. If not a data company, then what?
It is a behavioral environment, and the sheer financial mechanics demand respect before we even touch the software itself.
Sure, the numbers are huge.
355,000 terminals, $24,000 a year. There is no freemium tier, period.
None.
There are no bulk discounts for large institutional clients. You pay the standard price, or you simply do not have the terminal.
Yeah, they don't negotiate.
Never. And the brilliance of this business lies in what I call a four-gear flywheel. And I believe this flywheel is mathematically and behaviorally impossible to disrupt.
Okay, lay out the gears for me.
First gear is workflow dependency. Bloomberg didn't just aggregate data. They built the precise tools that traders use to actually manipulate that data.
Right, the analytics.
Exactly. The second gear is a proprietary messaging network that creates absolute, undeniable lock-in.
The chat function, yep.
The third gear is data comprehensiveness across every imaginable global asset class. And the fourth gear, which is crucial, is relentless reinvestment.
Because they're private.
Yes. It's funded by a private ownership structure that answers to absolutely no public shareholders. So Bloomberg does not sell data. It sells an indivisible, highly optimized active habit.
Well, look, the financial reality of $13 billion in recurring revenue is undeniable. I'll give you that.
It's a juggernaut.
It is. But the nature of that business moat is, I think, heavily misrepresented by the broader market.
How so?
Because what looks like a finely tuned neurological habit from the outside is actually just a combination of astronomical switching costs and institutional laziness.
Laziness? That's a strong word for Wall Street.
I stand by it. Traders simply do not want to relearn systems, and bank executives do not want to risk operational failure or their own annual bonuses just to save a few $1,000s per head on software licenses.
So you think it's just fear?
I think it's a historical pattern. To truly understand this, we must connect this modern narrative to a recurring historical phenomenon.
Okay, what pattern?
Bloomberg is simply the modern iteration of the Rothschild communication network.
Ah, the carrier pigeons.
Exactly. You capture a localized information advantage, and you quickly turn it into structural lock-in before everyone else gets access to the exact same data.
Interesting comparison.
The habit you describe is not optimized. It is fortified by fear. That cryptic interface isn't brilliant. I mean, it's an artificial barrier to entry that users leverage to signal their own expertise.
To justify their salaries, basically.
Exactly. They use it to justify their exorbitant salaries. But to really get into this, to understand the origin of this workflow dependency you're talking about, we have to transport ourselves back to the blind spot of Wall Street in 1980.
Oh, 1980 Wall Street. Picture a trading floor at a major investment bank like Salomon Brothers during that era.
Just chaos, right?
Total chaos. It was an environment drowning in raw data, but completely starving for synthesized insight.
Right, they had data, just no way to use it efficiently.
Precisely. Bond traders had access to an overwhelming stream of isolated information. They had price feeds from Reuters and teller rates scrolling constantly on these small, dedicated screens.
Just green text scrolling by?
Yeah. And they had news wires from Dow Jones and the Associated Press literally physically printing out on paper rolls next to them.
I can't even imagine the noise.
And then they had analytics generated by in-house quantitative teams. Plus, they communicated through banks of wired telephones and physical telex machines.
But nothing was connected.
Exactly. The critical failure of this era was that absolutely none of these systems communicated with each other. The data existed, but the integration simply did not.
Let's walk through the actual mechanics of a trade in 1980 to really illustrate that friction.
Let's do it.
Suppose a trader wanted to calculate a simple yield spread between two corporate bonds.
Which today takes, what, milliseconds?
Literally milliseconds. But in 1980, it was a disjointed, manual nightmare. First, the trader had to physically watch the raw price data scroll by on a Reuters terminal and write it down.
On a piece of paper.
On paper. Then, they had to manually input those numbers into a primitive spreadsheet on a completely separate computer.
Right.
Next, they had to cross-reference that output with credit ratings found in a heavy, physically printed book sitting on their desk.
A physical book.
Yes. Finally, they had to pick up a telephone, call up counterparty at another firm, and negotiate the trade based on this cobbled-together analysis.
It sounds exhausting.
It was. This fragmented process took 30 minutes to execute what should have been a 30-second decision.
And Reuters was the big player then, right?
Yeah, Reuters dominated the market data business at the time, but they were fundamentally a newswire company. They delivered information as a stream of isolated data points.
They didn't tell you what to do with it.
Right. They didn't tell the trader what the data meant, and they certainly did not provide the tools to manipulate it.
And that lack of integration, that was a structural problem that could only be identified by someone who had actually sat on a trading desk.
Someone who lived the pain.
Yes, someone watching professionals struggle with these disconnected systems day after day. And Michael Bloomberg possessed this exact perspective.
He definitely did.
He spent 15 years at Salomon Brothers. He rose from a $9,000 a year entry-level clerk to a general partner running the firm's equity, trading, and sales operations.
He was a powerhouse.
He deeply understood the market mechanics and the psychology of the trader. But, in a move of internal corporate politics, he was suddenly demoted.
Right, sent down to the IT department.
Exactly. To head the internal IT department, which was a huge slap in the face. And then when Fiber Corporation acquired Salomon Brothers in 1981, Bloomberg was pushed out entirely.
Fired.
Though he was fired with a $10 million partnership buyout.
Which is a nice consolation prize. But so what actually happened? Think about this for a second.
Okay.
We are constantly told this clean, mythological story of a visionary founder, right? The guy who saw the future of integrated technology and set out to build it.
That is the standard narrative.
But challenge that narrative. Was Michael Bloomberg a technological visionary? Or was he simply the only senior trader on Wall Street unlucky enough to be demoted to the IT department?
That's a fair question.
Because that demotion forced him to understand the underlying architecture of the systems he used every day. The insight was forced upon him by the demotion.
I see what you're saying.
He had the capital from his severance, yes, and he had the massive chip on his shoulder of a fired partner. The foundational insight of the Bloomberg terminal wasn't born of pure technological prophecy.
It was born of frustration.
Intimate, painful frustration with broken internal systems.
Well, the underlying motivation does not diminish the surgical precision of the resulting insight, though.
Fair enough.
Because the literal morning after his firing, Bloomberg took his $10 million and his granular knowledge of bond traders' broken workflows, and he decided to build the Market Master Terminal.
Market Master, what a name.
Right? He co-founded Innovative Market Systems, which of course would later become Bloomberg LP, with 3 former Salomon colleagues.
Yep.
They launched the first terminal in December 1982. Now, the brilliance of the Market Master was not that it possessed better data than Reuters.
It didn't.
No. And it didn't have better analytics than the in-house quantitative teams either. The brilliance was the strict, uncompromising focus on integration.
Putting it all in one box.
Exactly. A trader could pull a bond price, calculate its yield, compare it against treasuries, read the related news, and message a counterpart.
All on one screen.
All on one screen in one continuous workflow. He built a system around the way traders actually behaved, rather than forcing traders to adapt their behavior to the limitations of separated, siloed systems.
And the critical juncture for this new company, the moment that actually made them, occurred in 1984.
The Merrill Lynch deal?
Yes, it revolves around their first major institutional customer. Merrill Lynch recognized the value immediately.
They bought, what, 22 terminals?
They purchased the first 22 terminals, yes. And they also invested $30 million for a 30% stake in Bloomberg's young company.
Which was a massive validation.
Huge. And standard corporate strategy dictated that Merrill Lynch extract a massive competitive advantage from this investment, which they did.
Right, the exclusivity clause.
Exactly. They demanded a 5-year exclusivity agreement, meaning Bloomberg could not sell these revolutionary terminals to Merrill's direct competitors.
Giving Merrill a huge edge.
A profound execution advantage over every other bank on Wall Street for a short window. Yet just 2 years later, in 1984, Merrill Lynch voluntarily released Bloomberg from the exclusivity restriction.
Which seems insane at first glance.
Right? Why would a ruthless, hyper-competitive 1980s Wall Street bank willingly surrender a massive technological advantage to its direct rivals?
Because Merrill Lynch recognized a paradigm shift before anyone else in the industry.
They saw the network effect.
Exactly. They realized that the network effect of the platform was exponentially more valuable than the exclusivity of the tool.
Yep.
Having the best integrated terminal in the world is highly useful for internal analysis, sure, but financial markets are fundamentally about transactions and communication between different counterparties.
You need someone to trade with.
Precisely. If a Merrill Lynch trader wanted to execute a complex bond trade rapidly, they needed the trader at Goldman Sachs or Morgan Stanley to be looking at the exact same pricing model.
The exact same historical yield curve.
And the exact same news feed simultaneously. By releasing Bloomberg to sell to everyone, Merrill Lynch catalyzed the creation of a universal financial language.
And that decision birthed the messaging Moat.
It did. It allowed Bloomberg to build Instant Bloomberg, known as IB. Today, IB handles 40 million messages a day.
It's staggering. Let us analyze the business model of that specific messaging network for a second.
Okay.
Instant Bloomberg is essentially an enterprise social network that charges $24,000 a year just to be allowed in the room.
It's the most expensive chat app in the world.
Without a doubt, the network effects are absolute. If you are an institutional bond trader and you are not on IB, you functionally do not exist in the market.
You're a ghost.
You cannot see the shadow liquidity. You cannot participate in the rapid-fire negotiation of unlisted securities. You cannot share research instantaneously with the exact people who move markets.
Wait, before we move into the mechanics of those unlisted securities, define exactly what you mean by shadow liquidity in this context.
Sure.
Why can a trader not simply see the available liquidity on a standard open market trading application?
Well, in the equities market, buying shares of Apple or Microsoft liquidity is public.
Right, you look at the ticker.
You look at an order book on a public exchange, and you see exactly how many shares are available at what price. But the bond market, especially the corporate and municipal bond markets, operates entirely differently.
It's much darker.
It is highly fragmented and largely trades over the counter. Shadow liquidity refers to the massive volume of bonds that institutions want to buy or sell, but which are not officially listed on any public order book.
Give me an example.
Okay, say a pension fund might want to sell $50 million of corporate debt quietly without spooking the market.
Because if they broadcast it, the price tanks.
Exactly. They do not broadcast that order publicly. They message specific dealers directly through Instant Bloomberg.
Ah.
If you are not on that messaging network, you are completely blind to where the actual money is moving.
So leaving the network means cutting yourself off from the global conversation.
You're out of the game. Modern software-as-a-service companies spend billions trying to engineer this kind of viral network lock-in. Bloomberg achieved it decades ago by weaponizing FOMO, the fear of missing out, at an institutional scale.
The messaging network is undoubtedly powerful, yes. But I argue the deepest, most impenetrable moat lies in the user interface itself.
The black screen and the yellow text.
Yes. Consider the specialized keyboard and the proprietary function codes. A user types ALLQ for all quotes.
Right.
They type DES for description. They type YAS for yield analysis. Now, these codes are heavily criticized by modern software designers because they are entirely unintuitive.
You can't just guess them.
No, you cannot walk up to a Bloomberg terminal and guess how to use it. It requires weeks of intensive training. But once mastered, those codes become pure muscle memory.
Like a language?
Or think about a concert pianist playing a complex piece of music. Or a skilled professional touch typing at 100 words a minute.
They aren't looking at the keys.
They are not consciously thinking about where their fingers are moving. A bond trader who has spent 10 years typing proprietary Bloomberg codes on a specialized keyboard can execute a highly complex 5-step financial analysis in less than 3 seconds.
Because the keystrokes bypass conscious thought.
Exactly. Switching to a modern, point-and-click, aesthetically pleasing user interface with drop-down menus would actually slow them down drastically.
You think a mouse is slower?
It is a proven fact. Taking your hand off the keyboard to reach for a mouse takes a second and a half. In a market where millions of dollars are made or lost in milliseconds, the friction of the mouse is a massive financial liability.
I see.
So the switching cost is not financial. It is strictly neurological. Bloomberg does not sell a software license, it sells a highly tuned neurological habit.
Okay, but is a cryptic 1980s interface truly an optimized habit, or is it Stockholm Syndrome for finance professionals?
Stockholm Syndrome?
Yes. I vigorously challenge the premise that these function codes represent peak efficiency.
How can you challenge the speed, though?
Because if a competitor offered a workflow that was genuinely superior, one that utilized predictive analytics, natural language processing, and advanced intuitive data visualization, traders could adapt.
But they don't.
Human beings adapt to superior tools constantly. But they do not adapt in this industry because of massive institutional laziness.
I don't buy that it's just laziness.
The code memorization is not a feature of efficiency. It is an artificial barrier to entry. It is a gatekeeping mechanism.
To keep new people out?
Yes. Traders leverage their mastery of these arcane function codes to signal their expertise and justify their own high compensation to management. They want the job to look highly complex to outsiders.
Well, it is complex.
Sure, but furthermore, bank executives refuse to force migration to new, cheaper systems because the operational risk terrifies them.
The risk of downtime?
If a bank switches to a new platform and trading revenue drops for even 1 quarter while the traders learn the new system, the executive who authorized that switch will be fired immediately.
That is absolutely true.
Right? Nobody gets fired for renewing the Bloomberg subscription. It is profound institutional inertia masquerading as neurological optimization.
Okay, but if it is purely institutional inertia and gatekeeping, then how do you explain the graveyard of well-funded competitors who attempted to break the monopoly and failed?
They executed poorly.
No, the strength of the workflow dependency is proven by the 3 most significant assassination attempts on Bloomberg.
Let's go through them.
We need to trace each of these failures because each attempt attacked only a single dimension of what is fundamentally an indivisible workflow.
Right.
Take the first case, the price and data attack, led by Refinitiv, which evolved directly from Reuters.
A massive competitor.
Reuters had a 10-year head start on Bloomberg. They had the historical global brand. When Refinitiv launched its Icon terminal, it offered roughly 95% of Bloomberg's data coverage at a significantly lower price point.
Past the price in some cases.
Exactly. On paper, under traditional economic theory, Icon should have been the ultimate Bloomberg killer. It was a cheaper substitute with nearly identical utility.
But in practice, Icon barely dented Bloomberg's market share.
Barely a scratch. Why do you think that is?
Well, the fatal flaw in Refinitiv's strategy was assuming they were competing in a pure data market. Icon was engineered and marketed explicitly as a data product.
While Bloomberg was a workflow environment.
Exactly. Switching a trading floor from Bloomberg to Icon meant retraining hundreds of highly paid, highly impatient professionals. It meant breaking their daily routines and discarding their muscle memory.
And cutting them off from IB.
Yes, it meant disconnecting them from the instantaneous communication channels they relied upon to find that shadow liquidity we talked about.
So the data on Icon was perfectly comparable, but the workflow surrounding that data was totally foreign.
And bank procurement officers, looking only at the spreadsheet, saw the cost savings and mandated switches.
Only to face immediate open revolt from their trading floors.
Total revolt. Productivity plummeted, frustration spiked, traders threatened to leave for competing banks that still use Bloomberg.
And in many cases, banks quietly repurchased the $24,000 Bloomberg terminals they had just canceled.
Effectively paying twice just to restore peace on the floor.
Which proves my point. You simply cannot offer a cheaper habit.
Okay, but what about the second attempt?
The second major assassination attempt targeted the messaging network directly.
Right, Symphony.
In 2014, a powerful consortium of 15 megabanks, including Goldman Sachs, JP Morgan, and Morgan Stanley, backed a company called Symphony.
The heavy hitters.
The biggest of the big. Symphony was a highly secure encrypted messaging platform explicitly designed to replace instant Bloomberg.
And the consortium's thesis was that messaging was the sole reason they were trapped.
Right. If the banks could seamlessly communicate with each other through Symphony, they could drastically reduce their reliance on Bloomberg terminals, saving themselves hundreds of millions of dollars annually.
They threw $460 million at Symphony.
A massive war chest. And the system eventually reached 300,000 users.
But it fundamentally failed to break Bloomberg's grip on the front office trading desks.
Because the irony of this Symphony consortium is staggering.
It really is. The very institutions funding the destruction of Bloomberg were the exact same institutions writing Bloomberg's largest annual subscription checks.
So why did $460 million of concentrated bank capital fail to mandate a new chat application?
Because messaging on Bloomberg is not just chat.
No, it's not.
It is deeply integrated with data extraction, analytical modeling, and trade execution. A trader using Instant Bloomberg can pull a live bond quote, attach a customized yield curve chart, and send a specific trade proposition to a client in a fraction of a second, using 3 keystrokes.
And the recipient can click the quote right there in the chat window and instantly execute the trade within the exact same environment.
Symphony was just chat. It was an isolated communication layer completely disconnected from the underlying financial data.
So traders found themselves looking at data on one screen and turning to another screen to type about it?
The Alt-Tab friction. Symphony accidentally reintroduced the exact physical friction that Michael Bloomberg eliminated in 1982.
Which brings us to the third attempt. The third and most recent assassination attempt attacked from the angle of open source distribution.
OpenBB.
Yes, a company called OpenBB launched as a radical alternative, offering comprehensive financial data and sophisticated analysis tools entirely for free.
Completely free.
They raised millions in venture capital and built a highly passionate community of open source developers. They provided access to data feeds that would traditionally cost thousands of dollars a month.
Yet, OpenBB has entirely failed to penetrate institutional trading desks.
Why?
Because without dedicated enterprise deployment capabilities, without regulatory compliance and auditing infrastructure designed for regulators, and without the 44-year history of uninterrupted workflow reliability, free is not a sufficient value proposition.
Free doesn't cover compliance.
Exactly. OpenBB serves individual investors and isolated quantitative researchers perfectly, but it cannot support the synchronized, heavily regulated workflow of a global trading floor.
So the convergence of these 3 failures reveals a profound structural truth about enterprise monopolies.
Which is, you cannot disrupt an integrated workflow by unbundling a single feature.
Right.
Refinitiv tried to unbundle the data through pure price competition. Symphony tried to unbundle the communication network. OpenBB tried to unbundle the analytics through open source access.
And every single challenger failed because they fundamentally misunderstood the nature of the battlefield.
They thought they were fighting a software war. They were actually fighting a behavioral war.
We must expand the lens beyond finance to really understand the universality of this dynamic.
Okay, where else do we see this?
Well, the Bloomberg terminal is the absolute archetype of workflow lock-in. But the pattern replicates across every major technological sector. Consider Microsoft Excel.
Oh, that's a great example.
By objective computer science metrics, Excel is not the most powerful, efficient, or scalable data processing application available.
Not even close.
But it is the shared language of global business. The switching cost is not the price of an alternative spreadsheet software. The switching cost is the billions of hours of collective muscle memory.
The millions of intertwined legacy macros.
Yes, and the absolute certainty that if you send an Excel file to anyone on Earth, they can open it and understand it. The workflow itself is the moat.
And I want to connect this directly to the historical pattern we discussed in episode 4 regarding the Rothschild banking dynasty.
The Pigeon Network.
Right. The Rothschilds built Europe's fastest physical communication network using carrier pigeons and fast boats.
They famously used that network to receive the outcome of the Battle of Waterloo before the British government.
Yes. But the true genius of the Rothschilds was not the speed of the communication itself. It was how they aggressively converted that temporary physical edge into permanent relationship capital and structural dominance before the telegraph was invented. The telegraph eventually commoditized speed. Everyone gained access to fast information. But by then, the Rothschilds owned the foundational financial infrastructure of Europe.
I see the parallel.
Bloomberg executed the exact same playbook. They built the most comprehensive, integrated data terminal in the 1980s, and they converted that localized information advantage into unshakable workflow dependency before the internet and open source software commoditized market data.
The historical pattern is identical.
Convert a temporary edge into a permanent monopoly before commoditization destroys the original advantage.
Look at how this pattern manifests in the most valuable technology companies operating today. Palantir operates on the exact same behavioral principle.
In the defense sector.
Yes, they do not just sell a software license to the Defense Department. They deploy forward-deployed engineers directly into the client's operations.
They physically embed themselves into the daily, granular workflow of intelligence analysts and military operators.
Exactly. The raw data they process could theoretically be processed by other cheaper systems, but the integration layer, the specific sequence of actions the analysts take to interact with the data to make life-or-death decisions, becomes Palantir's proprietary environment.
So the switching costs are measured in the total loss of institutional knowledge.
Precisely. Or observe NVIDIA's CUDA platform.
The AI chip space.
Right, AMD produces graphics processing units that are highly competitive and sometimes superior on raw hardware performance metrics.
But NVIDIA spent over a decade building CUDA.
A software layer that artificial intelligence developers use to communicate directly with the hardware. Millions of developer hours are locked into the specific CUDA workflow. The hardware is interchangeable. The workflow is irreplaceable.
Workflow data is infinitely more valuable than market data itself.
Always.
Think about it. Reuters possessed the market data in 1980. They knew the price of a treasury bond at any given second. But Bloomberg possessed the market data plus the exact keystroke-by-keystroke record of what the most powerful traders in the world actually did with that information.
They could see the intent.
Bloomberg knew which analytical functions were executed 100 times a day and which were ignored entirely. They knew the precise sequence of commands a portfolio manager used to evaluate geopolitical risk.
And this proprietary workflow data allowed Bloomberg to optimize their product development with surgical accuracy.
Pure data providers could only guess what clients needed based on surveys. Bloomberg observed their behavior in real time.
And this level of observation, this relentless long-term optimization, is really only possible because of Bloomberg's corporate structure.
The private ownership.
Yes. Michael Bloomberg owns 88% of the company. Bloomberg LP has never been a public entity.
Which gives them enormous freedom.
They do not hold quarterly earnings calls. They do not answer to activist hedge funds, demanding short-term margin expansion or immediate cost-cutting.
No Wall Street pressure.
Ironically,
They do not face pressure to dilute their user experience by monetizing user data through advertising. This private ownership structure enables a level of structural patience that public companies simply cannot afford.
They employ what? Over 7,000 engineers.
Yes, and they operate a global news organization with 2,700 journalists. They continuously expand into esoteric asset classes, environmental, social, and governance metrics, and private market data.
So each massive reinvestment makes the terminal slightly more comprehensive.
And that comprehensiveness makes the terminal more indispensable to the multi-asset portfolio manager.
Which completely justifies the $24,000 price tag.
Which in turn generates the cash flow to fund the next wave of reinvestment. It is a perfectly closed loop. Public companies can attempt to build workflows, but private companies possess the structural patience required to fortify them into monopolies.
Well, look, we agree on the undeniable power of the Bloomberg flywheel.
It's hard to argue with the results.
The financial metrics in the sheer survival timeline dictate that respect. But where we maintain our fundamental disagreement is the psychological foundation of that lock-in.
You're still hung up on the laziness?
Yes. You view the Bloomberg terminal as an active, high-speed neurological habit, a finely tuned instrument that amplifies human capability.
I do.
I continue to view it as passive, risk-averse, institutional inertia. The terminal is a legacy relic that remains dominant primarily because the financial industry is structurally terrified of operational change. The complexity of the interface ultimately serves the ego of the user, not the broader efficiency of the market.
Well, regardless of whether the lock-in is driven by optimized muscle memory or institutional fear, the outcome is exactly the same.
That is true.
The ultimate insight derived from the Bloomberg anomaly is that the most defensible competitive advantage in the global economy is not a registered patent. It is not regulatory capture. It is not even possessing the absolute best individual technological features.
It's the workflow.
The ultimate advantage is coordinating the behavior of an entire industry into a shared, standardized daily routine. When your product becomes the environment in which your customers live and operate, you cease to be a vendor. You become infrastructure.
That's a powerful way to frame it. And I think we should leave the builder, the founder, or the investor listening to this analysis with a critical question to examine their own strategic positioning.
What's the question?
Look at your product architecture and ask yourself the hard truth. Are you selling data or are you selling a habit?
Because data can be commoditized.
Exactly. Because data, no matter how proprietary it seems today, will inevitably be replicated, open-sourced, and commoditized. Habits, once deeply entrenched across an entire industry, are nearly impossible to break.
Very true.
This is the research desk officially signing off.